A quiet rotation just completed that leaves retail investors wondering why their tech positions underperformed while small caps quietly advanced. The data is screaming about defensive positioning, not panic selling. Our metrics confirm a subtle but critical shift in capital allocation as inflation signals finally begin to stabilize. The consensus among the Canary community is that greed has cooled, but not from fear, from calculation. VIX dropped 2.6% to 14.25, while all three mega-cap indices surrendered ground. This isn't a cardiac event. It's measured deflation of leverage. Russell 2000 surged 0.51% as retail capital rotated into relative value rather than chasing growth narratives. Our metrics confirm credit markets are breathing easier, not tighter. The 10-year Treasury spiked 1.19% to 4.7%, signaling institutional repricing of Fed policy. Not a shock response, but an adjustment to expectations. With headline news focused on the 3.8% T-bill yield and potential rate hikes, capital is pricing in normalization rather than crisis. The indicators are signaling fear has been priced out of the system. UVXY shed 1.76%, while VIXY dropped 1.22%, confirming volatility products themselves are no longer crowded positions. The data shows fear isn't driving today's moves. It's merely clearing overhead resistance after 3 months of Nasdaq weakness. The real economy is showing signs the Fed narrative overplayed its hand. Weak US economic reports, not a recession signal, but a stabilization one. Curbed rate hike expectations. Cooling inflation data means capital no longer needs to price in aggressive tightening. Our metrics confirm this. IWM gained 0.58%, while SMH lost 0.45%. Revealing value is outperforming growth on fundamentals, not sentiment. Our portfolio protection strategy is working as designed. Bond dropped only 0.32% despite Treasury volatility, showing defensive positioning absorbed the shock without whipsawing. GLD climbed 0.47%, while XLP gained 0.15%, confirming capital flows into staples and commodities rather than speculative tech plays. The safety trade isn't hiding from risk, it's recalibrating exposure. The hero, your portfolio, is transitioning through a purification phase. The villain was overhyped Fed tightening, and the data confirms inflation is cooling faster than anticipated. Capital rotation favors relative value and defensive sectors rather than aggressive growth speculation. Your portfolio needs to breathe before it can chase again. Defensive positioning has done its work. Now patience beats position changes. The Canary dashboard shows markets are stabilizing around a new baseline, not collapsing into chaos. Watch the 10-year Treasury as your leading indicator for whether this calm is temporary or structural.